Well, hello everyone. This is Ken Winans and Stephanie Larson. We certainly, first and foremost, want to wish you a happy holiday season as we're coming up on Thanksgiving. And as we promised you at our last video, we wanted to, after earnings season, give you an assessment of where things are and what we expect for the remainder of this year going into January. So I'm happy to report that the companies that we owned in stocks and bonds and preferred shares posted very good earnings. Everything seems to be in camp. It is interesting to note, though, that there were many companies that we had been targeting all year that we elected not to go into, and many of them were badly mauled with missed numbers, whether it was because of COVID, whatever it might be, anywhere geopolitically in the world, they were affected. Steph, you want to add anything to
Not
that?
just earnings in general. If you missed earnings this year, revenues, whatever it happens to be, you were absolutely punished. So, I mean, there were some big 6, 7, 8% drops on some names. Not our names, but it was very. I think the complacency that investors have, or the to just roll with it. I think investors are starting to really pay attention to fundamentals again, and they're not. If you're missing your targets, your fundamentals are weakening. Investors are not having it. So it was interesting.
Well, and also, we talked about earlier this year, we've had concerns about valuation on U.S. equities, and that been a big part of our reason why we have been cautious all year, is that if you are in a security, and as Stephanie said, and it missed, at these valuations, it ended up getting creamed. The other thing we should talk about is that a lot of the commodity ETFs that we owned actually did rebound very, very well in the fourth quarter, and we were a little early on the commodity call, but certainly corn and any of the commodity indexes that we own that have ties to crude oil have done very, very well.
Yeah, I think in general this year, we were a little early on some of our calls. We've been talking about inflation all year. Not that it was here, but that it was coming. Well, now it's here. I think it's very, very clearly here. I think that we're spot on with our analysis, and I think we have positioned the portfolios really well. And actually, I think you'll notice that quarter to date, especially on the equity side, we've done exceptionally well this year.
Absolutely, yeah. We're going to end on a very good note with our portfolios, knock on wood. Yeah. So let's talk about seasonality in the markets a bit, because as you all know, that we've done extensive analysis on how the market reacts through a given year. And in my case, I've taken it back to the 1930s to see what happens. And there's a pronounced positive effect, even in bad years, which this is not one of them, but even in 2008, this was the case, where November and December are typically good months. They end on a good note. It's often referred to as the Santa Claus rally. I have reasons to believe that although it's not going to go straight up, that we will end the year on a very good note as we set up for next year. Now that's the good news. The bad news is that we do think that now that Jerome Powell's leadership in the Federal Reserve has been secured with his renomination, that the Fed is going to have the handcuffs taken off of it to do what is necessary to raise interest rates to combat, as we see it, a rising inflation that, quite frankly, they're talking about the early 90s. I think we're now going back to the early 80s on where we are right now with the pricing problems in this country.
I think that, and actually Ken's said this a few times, that Jerome Powell should be neutral, but he is still, unfortunately, turning out to be a little bit more of a political animal than we would have liked. He wanted to get reelected, so he reserved not to change rates or to really, I mean, they started to prime the pump a little bit, talk about tapering, talk about the bond buybacks, and this is going to happen at some mythical date in the future. But he hadn't actually done anything because he wanted to secure his renomination. Ken's been saying that for months now. And unfortunately, it came true. I personally was a little surprised that he got renominated, but I think none of the other candidates were good enough. And so they just went with what they knew and someone that had been in the thick of it, something that would appease both sides of the political aisle, mostly. So I was a little surprised, but Ken's right. Now he can take liberties. I mean, if you were in D.C. You want to talk about what you...
Well, I was in, I think I might have mentioned on my last video, I was in D.C. for a week and met with a lot of elected officials and people who work in the bureaucracy of the federal government. And very much when I raised the issue that I was a Morningstar ranked money manager and also write for Forbes magazine, and that I really wanted to pick their brain on the inflation thing. And I asked them point blank, I said, do you honestly believe that this inflation is temporary? And one gentleman in particular said, do you want the political answer or the real answer that we all believe? Well, of course, I wanted the real answer. He said, we agree with you 100%, that this is not something that's going to suddenly disappear. Now, but with that being said, let's just also talk about, we're not trying to scare you in this video, but it's important for you to realize that we are looking into 2022. We're trying to get prepared for a world where interest rates are going to go up, that the effects in the equity market and the real estate markets will be pronounced, and we are going to be getting everything prepped for that. At the same time, I just did a Forbes article talking about where I do think that whether we see it now or in the not distant future, taxes on investment-related issues are going to go up across the entire slate. I think it's safe to say that even people in real estate that I talk to feel that the 1031 exchange programs that have been in place for probably 40 years, the government's going to begin to take those out. So the point being, we're going to be facing higher inflation, higher taxes, and investment strategies have to adjust for that. And we will be doing more of that as we go forward. But just keep in mind that, again, for the remainder of this year, we think we're going to end on a very good note. Stephanie and I are getting everything prepped for January. January is a big month because you have the State of the Union address, you have the Federal Reserve come up with its policies. Most central banks around the world come out with their stated policies. We have earnings coming out from all the year-end earnings coming out for the companies and their guidance for the rest of the year. It's a big month for data, and it does set the tone for the year.
Yeah, I'd agree. And part of what Ken and I have done on the investment side, it's twofold. One, for the equity, we've gotten the accounts mostly fully invested, except for a few exceptions which are client specific. We've really tried to take advantage of the seasonality of the end of the year, part of why last month was so good and our quarter to date number is so strong. But what we're also doing is preparing for January. You know, what happens if Jerome Powell raises rates and things go off with a bang, and you know we'll enact our risk mitigation protocol, you know, raising cash, hedging, things like that. But on the bond side, it's actually a very different situation. What we've been doing for this past year, slowly, has actually been bringing down the maturity schedule of our bonds. We want to make sure that when rates go up, bond yields will also go up with them. It's not instantaneous, but it will actually happen, because otherwise, why would anyone buy the debt if inflation goes up and you're still only getting 4 or 5%? No one would buy the bonds, right? So current prices for existing bonds will soften. This will be good because I can buy bonds again at a deep discount. Or if I buy a newer bond, it will have higher yield attached to it. So this is actually a really good and exciting time. So the reason why we brought our maturity schedule down is that we wanted more money coming to mature, more money coming back into your accounts from these bonds maturing, so that we can go after the new paper when it becomes available. So we're really focusing on that on the bond side. We're prepping for the accounts to have some money in them, so that we can take advantage of the new bonds when they hit the market, hopefully in maybe 6 months to a year, I would hope. See paper change. At the meantime, prices are still pretty tight. I can buy bonds. I am finding them at a reasonable price, but it's really hard. I mean, the pickings are getting pretty slim. If you look at your bond portfolio at the price at the end of the quarter, or even just last quarter, of what the bonds are quoted at, because I use that term loosely, you'll see how expensive they are. They're well over par, which is $100. They're at 103, 106, 110. I mean, bond prices are just astronomical right now. If I had a new account with all new money and I had to build out a full portfolio, it would take me much longer than normal, because it's just hard to find paper that's appropriate. So we're really excited about the bond space moving forward, because this change will actually be a good thing for investors. We're going to ladder the portfolios that way to take advantage of the interest rates and help mitigate the inflation.
And to bring up what is said, I mean, this is all by design.
Yep.
When I first designed the entire bond buying program, for many of you who have been with me since inception in 1992, you know that we've always used a laddered strategy on some bonds coming due at various points in times. And part of it is just my education when I started in the markets, as far as working in the investment field. The memories of what happened in the 1970s was still alive and well on Wall Street. And we were taught to respect it and not to think that inflation is gone and never going to return, as we found it has. But folks, just remember that part of what you pay us to do is to be thinking about what's going on, conveying to you, just to not worry, trust that we are on top of this, that we know what we are. We have a plan set up for what to do with the next bear market, how to select the new securities. I am still planning on this company filing, as we are a registered investment advisor. On the commodity side, it's called a commodity trading advisor. We should have that filing in place probably within the first 4 months of next year, and that we'll be able to actually do more commodities business, and actually be one of the few people in the Western United States that actually has that dual registration. Some other good news, we did have our Morningstar rankings come out for the end of September, and knock on wood, we're still liked by the rating agency. Most of our strategies came in with very strong rankings and still demonstrated lower risk, being able to produce better returns without taking big bets. And so that was all very good. Hey, before we forget, Amy and Mindy did a video yesterday, and we encourage you to read it because it does deal with things that are going on at the brokerage houses regarding people who need to take things like minimum distributions out of their IRAs, wanting to open new accounts. Somebody wanted to give their grandchildren stock, what you name it, we hear it, I've heard it for years. But the reality is things in the custodians are still not back anywhere remotely close to 100%. And in fact, as we've heard before, we are examining our choices on various types of custodians, but with the Schwab TD merger being fully implemented, being pushed out for at least 2 years, we're going to leave it alone for now while we continue to assess what we want to do and how we want to go about doing it. Only because it would just, folks, it would be a nightmare trying to move anybody around right now. I just don't want to take that chance with where we are in the markets. It's just not remotely something we want to deal with if we have to put defensive strategies in place. But listen, we hope you have a wonderful holiday season and enjoy, hopefully have a good Thanksgiving, and certainly enjoy December. And we certainly hope to see most of you in the first quarter of next year, especially clients who are not in the immediate Bay Area. I do plan to get out and travel again, especially out to Las Vegas. We're going to be out there a lot more often, seeing our clients out there. So anyway, Stephanie, anything else you want to add?
Yeah, I would just say, to touch on the Mindy part, when I call the Schwab or TD, I can get through pretty easily because I'm actually talking to traders, so that's time-sensitive information. But when she's dealing with operations stuff, she actually can be on hold for like 20 minutes at the minimum without even talking to anybody. It is actually ridiculous. So if you have year-end requests, please get them in. Also, I would say that Amy's doing a new kind of initiative in her client service role. She's going to be trying to touch base with every single one of you this year. We want to make sure that you guys have a good experience, that there's no feedback for us that you need, that is there anything else that we can help or to enhance your experience with us. So be prepared for her to reach out. There's nothing wrong. She just wants to touch base and check in and kind of do a well check for everybody. You know, she's going to evaluate everyone's portfolios and situations, meaning whether you have correct beneficiaries or structures or things like that, and just make sure there's no changes that happen naturally through the evolution of your life that need to be done for your portfolio. So she will slowly be reaching out to every single one of you, and if you're local to the Bay Area, she can go in person if you prefer. So just that's coming down the pipe.
And also one final note on Tamarac. Now, you know, we put in place a beautiful brand new system, and for those of you who have not activated it online, I would encourage you to do so because many of you are going to start asking for your tax information. That is all available right now on Tamarac, where you can see immediately where you are on realized long-term gains and losses. And so there's no reason for you to even call us here. If you go on Tamarac, you can download the information yourself, or have your accountant do it for you. So we encourage you to take advantage of these new capabilities that we put in place because it is meant to help you have an easier experience in investing with this company and what we're doing. So anyway, we wish you all well. And certainly try to enjoy we all have much to be thankful for. So please enjoy your Thanksgiving, and we'll put out another video in December.
Yeah.
Take care, folks.